Good day everyone. What we're going to do in this example is to look at the production of a statement of cash flows, and in particular cash flows from operations, using the indirect method. In practice, the indirect method is far more popular than the direct method, even though the Financial Accounting Standards Board, when it set the standard back in the 80s, would have preferred, and indeed did, recommend that companies use the direct method. But since the indirect method is used more widely, I wrote this example to show how and why we need to make the adjustments to net income that are part of the indirect method. So let's look at the case of Jane, who runs a pineapple business in downtown DC, selling pineapples to tourists on the National Mall. And she starts off the day, we're told, with $10,000 in cash. She buys 500 pineapples for cash at the beginning of the day for $1,500. During the day she sells most of them for $2,500. All customers pay in cash, and any pineapples left over are not in a condition to be sold subsequently, and so she throws the leftovers away. And so this would be a fairly simple example to produce an income statement for. We can say that the sales are $2,500. The cost of sales is just the purchases, which is $1,500. And so we can say the gross profit is $1,000. There are no other expenses. The net profit is $1,000. And if we were producing a statement of cash flows using the direct method, we'd say the cash from operations is, well, cash from customers, which was $2,500. The cash paid to suppliers is $1,500. And so the cash from operating activities under the direct method is $1,000, exactly the same as the net profit. And using the indirect method, we'd say the profit is $1,000. There are no adjustments, and so the cash flow from operating activities under the indirect method is $1,000. The net change in cash is $1,000. And given that she started off the day with $10,000 in cash, we'd say she should end up with, whoopsie daisy, just rechange that. She starts off the day with $10,000 in cash. It must be that she ended the day with $11,000 in cash. So if everything's a pure cash business, there's no difference between profit and cash flows. Two methods are identical. But let's take the case where it's slightly more complicated. And in case 2, so a different Jane, this is not the next day, this is a completely different first day, we're told that she buys 400 pineapples for cash at the beginning of the day for $1,200. During the day, she sells 2,000 of them, all in cash, and she has 100 pineapples left over, which she'll keep and sell the next day. So in this case, they're not rotten. She's going to carry them over until the next day. So we'd say, what are the sales? Well, the sales were 400 pineapples, and that one she bought for $1,200. That was purchases. She sells for $2,000. So sales are $2,000. The purchases we know are $1,200. But now when we work out cost of sales, we say, aha, it's not just the purchases. We need to take into account the beginning inventory, and we need to take into account the ending inventory, and then cost of sales is going to be beginning inventory plus purchases less ending inventory. Well, beginning inventory is 0. She started off the day with nothing. But ending inventory is how much? Well, $1,200 for 400 pineapples, so that's $3 each. She had 100 left over, so it must be that ending inventory is $300. If we subtract ending inventory of $300, we can see cost of sales is $900, and so the sales of $2,000 less the cost of sales of $900 gives us a gross profit of $1,100, and there are no other expenses, so net profit is $1,100. Now, using the direct method of cash flows, we'd say that what was the cash from customers? Well, that was a sales revenue, and the sales revenue was $2,000. The cash paid to suppliers was $1,200, and we can see that, okay, it must be that the cash from operating activities is $800. The $2,000 from customers less the $1,200 paid to suppliers. And yet the net profit, as reported, is, in fact I'm going to put this in as a formula, the net profit as reported is $1,100. So what's the difference? Well, the reason why the cash from operating activities is only $800, whereas the net profit was 1100 is, of course, that there was a build-up of inventory. There was $300 spent on inventory, which hasn't yet been reflected as an expense in the income statement. And so we need to subtract that increase in inventory. We started off the day at 0. It ended up at 300. So that increase in inventory we're going to subtract. And when we subtract the increase in inventory from the net profit as reported, then that gives us cash from operating activities using the indirect method of 800. And again, there was no other transactions. I'm going to copy this across because this is the same for all of them. The beginning cash balance was 10,000, and so the cash balance at the end of the day is 10,800. The 10,000 she started off with plus the 800 profit from operations. In the third example, again, this is not day 3, this is a completely different first day of trading. On the first day of trading in case 3, she buys 500 pineapples for cash at the beginning of the day for $1,500, and during the day she sells 450 of them for $6 each, which is great. And her biggest customer is a staff association at the Air and Space Museum, which buys 100 pineapples and agrees to pay at the end of next week. All other customers pay in cash, and any pineapples left over are not in a condition to be sold subsequently, and so she throws the leftovers away. So what would this look like as an income statement? Well, we'd say the sales revenue was how much? During the day she sells 450 of them for $6 each. So we have 450 multiplied by $6 each, which is $2,700 for sales. The beginning inventory was 0. In fact, the beginning inventory is going to be 0 in all these cases. The purchasers were, well, we're told she buys 500 pineapples for cash for $1,500. So purchasers are $1,500. And ending inventory is 0 because we're told that anything left had to be thrown out, so nothing there. So ending inventory is 0, so cost of sales is the same as purchases in this case. And so gross profit is, copy this across, gross profit is the $2,700 sales revenue less the $1,500 cost of sales. The gross profit is $1,200. Again, there are no other expenses in this case, and so the net profit is $1,200. And if we look at the statement of cash flows using the direct method, then we'd say that the cash comes in from customers. How much is that? Well, of course, it's not the same as the level of sales in this case, because her biggest customer was a staff association at the Air and Space Museum who bought 100 pineapples, and they're not going to pay until the end of next week. And so the only cash that came in from customers was the general public, who apparently bought 350 pineapples. And so the cash that came in today was 350 lots of $6, $2,100. The cash paid to suppliers is what we said earlier, which is the $1,500 to the supplier at the beginning of the day. And so the cash from operating activities using the direct method we can see is only $600. Well, how does that compare with a net profit of $1,200? And again, let's copy this across. We can see that the net profit as reported was $1,200, but the cash from operating activities was only $600. Well, why is that? It's clearly not anything to do with an increase in inventory, and it's the build-up in accounts receivable. We can see that at the beginning of the day there was 0 accounts receivable, but at the end of the day the increase in accounts receivable had gone from 0 to 100 lots of $6, which is the amount of money that will be received from the staff association at the Air and Space Museum when they're going to pay next week, at the end of next week. And that should be negative. So that increase in accounts receivable, when we subtract that, that's why, yes, the net profit was $1,200, but it wasn't all received in cash. $600 is going to be received the following week. Third reason why there might be a difference between net profit and cash flows from operations is because of changes in accounts payable. And so in this fourth situation, we're told that she buys 500 pineapples at the beginning of the day for $1,500, and the supplier agrees to grant credit to Jane so that she pays 60% of the purchase price immediately in cash, and the balance will be due the following day when she comes back to buy more pineapples. During the day, she sells most of the pineapples for $2,500. All customers pay in cash. Any pineapples left over are not in a condition to be sold subsequently, and so she throws the leftovers away. So again, we can do a fairly straightforward statement of income, which is that the sales revenue is the $2,500. We're told that she sells most of the pineapples for $2,500. The beginning inventory again was zero. The purchases were $1,500. We're told that there was zero ending inventory because anything left over had to be destroyed. So the gross profit is $1,000. There are no other expenses in this case, and so the net profit is $1,000. And so the operating cash flows under the direct method is the $2,500 cash from customers. But of course, the cash paid to suppliers is not the whole of the $1,500. Apparently the supplier agreed to grant credit, and so she only had to pay 60% of the $1,500, which is $900. And so, cash from operating activities, $2,500 from customers, $900 to suppliers, so there's a net build-up of $1,600. Why is that different from the $1,000 net profit? And the answer is that, well, there was this build-up in accounts payable, and so what we're going to do is to add an increase in accounts payable, and we can see that accounts payable went from the beginning of the day, the balance was zero. At the end of the day, the balance on accounts payable was the $600, and so we add that increase in accounts payable, and so the cash from operating activities is the net profit of $1,000. We add the increase in accounts payable, which is $1,600, so the net change in cash is $1,600. The same using the indirect method as if we used the direct method. Let's look at another example why there might be a difference, and this is actually a very common reason for a difference, and that's to do with depreciation, or in this case amortization. So in case 5, again this is not day 5, this is just a fifth variant of the first day of ever trading, and we're told that she starts off the day with $10,000 in cash. She buys a license to trade for $2,700, and the license will be good for the whole season. But because of likely bad weather, she estimates that she'll only be selling pineapples for 180 days during the season. And so it makes sense to say, well, if she's only trading for 180 days, then the amortization of that license will be $2,700 divided by 180 days in the tourist season, so $15 a day. Amortization expense of this license. On the first day of trading, the weather's fine, and she buys 500 pineapples for cash at the beginning of the day for $1,500. During the day, she sells most of them for $2,500. Everyone pays in cash, any pineapples left over not in condition to be sold subsequently, and so she throws the leftovers away. And so we can say that the sales revenue, in this case, is the $2,500. Again, no beginning inventory, no ending inventory, but there were purchases of $1,500. And so cost of sales is $1,500, gross profit is $1,000. But now we know that from this gross profit we're going to have to subtract the amortization of the license, and the amortization of the license is, we just said, the $2,700 divided by 180 days, so $15 per day. So for one day of trading we'll subtract the $15. And so the net profit is the gross profit of $1,000 less the amortization expenses of $15, net profit of $985. The statement of cash flows using the direct method says that the cash flows from customers is the $2,500. The cash paid to suppliers is $1,500, and so there is cash from operating activities under the direct method of $1,000. Why is that different from the net profit? Well, we can see that it's the net profit of 985, but that 985 was after charging an amortization expense of $15, and that wasn't a cash flow. And so what we have to do to get from net profit to cash flows from operations is add back the amortization. And so we add back the amortization of $15, and that gives us the $1,000. So the cash from operating activities is 1,000, but of course we also know that in this case there was the cost of the license fee, which we're actually going to call an investing activity, and that license fee was $2,700. And so overall cash on the purchase of the license, so the net change in cash was actually a decrease of $1,700, and so beginning of the day cash balance 10,000. She ends the day with $8,300. Okay, so now let's pull everything together in a day or a first day of trading where everything's going on. And so in situation 6, we're told that she buys a license to trade for $3,500. The license will be good for the whole season. Because of likely bad weather, she estimates that she'll only be selling pineapples for 140 days during the year. So now we're actually going to have amortization of the $3,500 divided by the likely season of 140 days. So that's going to be $25 per day amortization when we get there. On the first day of trading, the weather is fine, and she buys 600 pineapples for $3,000. The supplier agrees to grant credit to Jane so that she pays 75% of the purchase price in cash immediately, and the balance will be due the following day when she'll come back for more pineapples. Her biggest customer is the Staff Association at the Air and Space Museum, which buys 120 pineapples for $7 each and agrees to pay for them at the end of next week, and all other customers pay in cash at $8 per pineapple. And she has 100 pineapples left over, which she expects to be able to sell the following day. So let's pull together what we've got. If we're doing sales revenue, well, the sales revenue would be the sales of the pineapples to cash to the general public plus the sales on credit to the Staff Association at the Air and Space Museum. And how many is that? Well, we know that she bought 600 pineapples. We know that the Air and Space buys 120 of them for $7 each, so equals 120 multiplied by the $7 each. So that was the sales on credit. And then there were plus some sales for cash. It doesn't tell us how many pineapples were sold for cash, but we know that she bought 600. She sold 120 to Air and Space, so 480 left. She had 100 left over, so it must have been that 380 was sold to members of the general public for $8 each. So 120 at $7 each plus 380 at $8 each is total sales of 500, and she had 100 left over. So 3,880. The beginning inventory we know was 0. The purchasers we know were, on the first day she buys 600 pineapples for $3,000. And the ending inventory is 100 pineapples. Well, the $600 for $3,000 for 600 pineapples means they cost $5 each. That's 3,000 divided by 600. She has 100 left over, so ending inventory is less 100 multiplied by this $5 each, or if you like, multiplied by the cost per pineapple, $3,000 divided by 600. $500 worth of inventory, and so cost of sales is $2,500. And gross profit then is $1,380. The amortization of the license we said was equal to less the cost of the license, $3,500, divided by 140 days of trading. So that was $25 per day, and so the net profit is $1,355. If we look at the cash flows coming in from customers, we know that the only cash that came in from customers was based on the sales of the pineapples for cash, and that was, if you recall, going back here, 380 pineapples at $8 each, so equals 380 at $8 each, 3,040. The cash paid to suppliers, well, we know that the pineapples were in total going to cost $3,000, but the supplier agrees to grant credit such that she only had to pay 75% of that amount today. So to suppliers is 3,000 multiplied by 75%, 0.75, 2250. And so the cash from operating activities using the direct method is 790. Well, how does that compare with the net profit as reported, 1355? Oh, we can see there's a difference. And why is there a difference? Well, we know we have to adjust for changes in inventory, changes in accounts receivable, changes in accounts payable, and amortization. So let's do that. So the increase in inventory, we can see that at the beginning of the day there was no inventory. At the end of the day there was $500 of inventory. So we're going to subtract this $500 increase in inventory. The accounts receivable at the beginning of the day was nothing, but at the end of the day we know that the Staff Association at the Air and Space Museum owes $120 pineapples at $7 each. So less 120 multiplied by the $7 each, there is an increase in accounts receivable of $840. On the other hand, she didn't have to pay the whole of the $3,000 to the supplier for the pineapples, and so the increase in accounts payable is the 25% of the purchase price of the pineapples, so it equals 25% of the 3,000. That's $750, which is going to pay the next day. And then there was the amortization, which we know we put through as an expense, but it's not a cash expense, so we add back the $25 cash amortization. And we can see, okay, by the time we've made these adjustments, the cash from operating activities using the indirect method is 790, the same as we picked up from the direct method. Of course, there was also the cash flow for the purchase of the license, which was $3,500. And so overall, the net change in cash was, again, let's make this a nicer format. Net change in cash was 2710. She started off the day with 10,000 and she ended the day with 7290. And so you can see that overall, when everything's thrown in together, it's going to be a lot easier to start off with the net profit, look at the balance sheets beginning of the year, end of year, to see what was the change in inventory, what was the change in accounts receivable, what was the change in accounts payable, and add back amortization and more typically depreciation to give us cash from operating activities, and then there'll be investing activities and maybe financing activities too, which we'll deal with separately.